Welcome everybody to this week's Middle Class Investor. This is Seth Martin, your host. Got a picture of the Dow Industrial Average on the screen here, and you can see here that we had an up week. Each one of these is a week, so we've had really 1, 2, 3, 4 really strong weeks in a row, and it just looks like the market can't do anything but go up. So if you're in the market, then this is great. You're making money, and there's nothing to do but sit tight. We were looking at some gaps on the S&P 500. Actually, both of them filled, and I think I said that if they filled, the market would likely make a new high. So what's interesting is the Dow. Let's see. I'm not sure the Dow has made a new high. Let's look at a 9-month chart here. We'll zoom in on that. Here's the previous high right here, which was at 17,150.156, and here's the most recent high, which is 17,153.80. So that is a new high. So we got a new high, and then we pulled back. So we could, to me this looks pretty strong, so this could continue to rise a little higher. It's hard to say how much higher, but going back out to the weekly chart, you can see that we are above the this red line right here, which is the line that connects the 2000 and 2007 highs from the beginning of the dot-com and then the financial crisis. And then this line, all we did was extend it out into the future. So you can see that there were several weeks here where we spent above it, we sold off hard, and then we pulled back pretty strong back to above it. So on the S&P 500, we've been talking about this rising wedge. The Dow has a rising wedge also. It's just not as well defined. And it's interesting because it kind of broke out to the upside but then sold off immediately and then broke out again. I'm not sure what this means. I'm thinking this is maybe potentially a fake out, because normally if you find these on like daily charts, sometimes it will poke out to the upside and then sell off hard. So what's interesting is it's poked out to the upside, sold off, and is poked out to the upside again. And you don't normally see that, but at the same time, I'm not used to seeing such a large pattern that has lasted for so long. So it's hard to say what all that means. It could mean nothing. So right now we're not going to worry about it too much. You can see from just the proportional nature of this chart that this pattern is coming to an end, and we should be seeing something to the downside soon. The key area that I've kind of got on the chart here for me is below this low right here. So I would say, maybe this 1895 area. If the market certainly if it gets down to 1895, it will be outside of this wedge pattern. But I would say that this low is real key here, and if this low breaks, we're probably going to be looking at a potential trend change. Now that doesn't necessarily mean that you sell right there. You could sell right there. You could say, well, because let's see how far that is. Let's say that it just sold off next week and went below that low. That means you'd lose about 5.5% on your account, and maybe that's not such a bad deal. To go ahead and take 5.5% loss and move along. But a lot of times what happens when this breaks out, now it could break down into the 1650 area and then retest up here to about 1850. So it just depends on how conservative you want to be and how comfortable you feel about getting back in. If you make a decision to get out, are you one of these people that's comfortable about getting back in, or do you kind of stay on the sidelines for a while? So it really just depends on your own ability to change your mind once you've made a decision. So there's nothing wrong with making a decision, but as soon as you recognize that that was the wrong decision, you want to be able to change your decision and go back. So that's kind of the key, and that's really what I want to try to help you guys with. I'm not here to tell you what to do with your money. It's your money. You're going to ultimately do with it what you want to do with it. But if things do start to sell off, I want to try to help people make a good decision. And if we make a good decision, but it was premature, then I want to help you change your mind and resume. So that's kind of what we're doing here. Let's look at the 10-year interest rate. To me, this is the key thing to watch. Again, if and I want to say if pretty strongly, if this is the initial move off of the low up to this area, and then this is the first pullback, then this next move up from here should be significant. So it's holding pretty strong in our blue box here. We've actually, what's interesting is we actually touched this 22.98 area twice. And so what that means 2.298% yield on the 10-year Treasury. So we came down and hit it this week and then touched it again this week. And I'm guessing we're probably going to break this low a little bit, probably down into this area. So look for that to go a little bit lower, maybe into this, let's see, what is that? This would be maybe just slightly lower there, maybe into the 2.25 range or something like that, and then resume up. So we're going to be watching that very closely and reporting on that. Again, I just left this, but let me go back to it real quick. And I haven't explained this, and maybe I need to explain it real quick. A bond, if you can buy a bond, the bond has a maturity date. So let's say you bought a 10-year Treasury. That means, and the face value of the bond is, $100, and you bought the bond for $70. What that means is, even if interest rates go up and the value of the bond goes down, that means that at the end of the 10-year term, the bond will be worth $100. So you can't lose any money on that kind of purchase. In a bond fund, it's made up of a bunch of different bonds, all with different maturities, and so there's no way to hold the fund to a maturity date. So what happens is the value of the fund is rated every day based on the rise and fall of the prices of the bonds. So in very simple terms, if interest rates are going up, the value of the bond is going down, and therefore the fund, the value of your fund, if you had a bond fund, would be going down. I hope that's not confusing, everybody. It sounds confusing when I say it, for sure. So this is interest rates falling in this direction, and of course if they bottom here and start to go up, this is going to be interest rates rising. And if interest rates are rising and you have a bond fund, it will be going down in value. Let me just let me demonstrate that real quick. Let me see if I can get a left scale. Let me just add. Let's look at the HYG and add it as a left scale. And you can see how these diverge, right? The HYG is going up as the interest rates are falling. But if the interest rate, the black bars, if they start going up, then this HYG is going to start coming down. Okay. Another one we could probably look at is this one always confuses me. I can never remember if it's the TLT or if it's the TBT. It's the TLT, so I got it right. So this is a really good one here. You can see the relationship between the value of the bond. So this is the value of the bond going down, and this is the interest rate going up. And then you have the value of the bond coming down, and you can see the interest rate going up. I'm sorry, the interest rate coming down and the value of the bond going up here in blue. So if you were to, it almost looks like there's a mirror. If you laid a mirror right here, it's not quite a mirror, but if you laid a mirror right here, it's almost a mirror image of one another. So hopefully that explains that a little bit. The TLT it's the, I guess that's, let's see, that would be, the TLT is going up. So the TLT follows the value of the bond. So as yields come down, this is yield, okay, the value of the bonds go up. So TLT, if you thought bonds were going to go up in the future, you'd buy the TLT. If you thought bonds in the future were going to go down, you would buy the TBT. So let me just show that real quick. Let me get off the 5-year. Let's do like a 2-year and then a TBT. So notice the TBT has been down lately. That's because interest rates have been falling. But if interest rates start to rise, the TBT will rise. So the TBT is a way you could short the bond market if you wanted to. I would say it's a little bit premature right now. This is still falling, but certainly that's something you could do. All right, let's go to the euro. Euro US dollar. Now, last time we talked about the euro. It went through this area of support. It kind of retested and then sold off. And we talked about this being the next area of support. And it looks like really this is kind of just barely hanging on. So the next area of support is going to be down here. And I talked about the possibility of the dollar and the euro ultimately becoming equal in value. In other words, instead of having to pay a dollar, right now you have to pay $1.3120 to buy 1 euro. But if this comes all the way down to 1, that means you'd spend $1 to buy 1 euro. And it could very well be that that's where we're headed. Who knows? It seems like a logical kind of thing. If the dollar is increasing in value and the euro is decreasing in value, then maybe they meet at 1 and trade sideways for who knows how long. We talked about volatility last week. Volatility is also called the fear index. Now, some people think volatility is just a stock moving around a lot. And that's kind of true too, but when they talk about the fear index, what they're really talking about is the market's appetite for puts on the S&P 500 index. So if the market is very, let's say the market was selling off really hard, well, what happens is investors, big money investors, they can't just go to cash. So what they do to hedge their positions is they buy puts, S&P 500 index puts on the S&P 500 index. And then what happens as the index falls, their puts become more and more valuable. So it helps offset their losses that they would otherwise take on the S&P 500. So the VIX basically is like, it's almost kind of like an oscillator, and it shows the value or the willingness, I guess is the way to say it, of investors to buy puts on the S&P 500 index. So if the VIX is low, that means nobody's buying puts on the S&P 500 index. If the VIX is high, that means people are paying not only are they buying a lot of those, but they're paying high premiums for those put options. So right now the VIX is looks like it bottomed out, kind of 1st of July, and it's been oscillating back and forth, and looks like it's trying to make a lower low. But who knows? It looks like maybe it might stop here and start go higher. So if it starts to go higher, that generally would mean that the market would be going lower. Now that's very general. Sometimes you'll see some differences in the VIX. So, like for example, last Friday, the VIX was down 0.58%, and if you go look at the S&P 500, it should have been up, right? Let's pull up the S&P 500 and see it was up 0.33%. That's usually the relationship. If the VIX is down, that means the market's up, and just the opposite. If the market's down, the VIX is up. Occasionally, you'll see those perform slightly out of phase, and it could give you kind of insight into a future move. Although, I don't know that that's definitive. So I don't know that I would look at that. But you should see. You're typically looking for a confirmation. So if the market's up, you go to the VIX, and the VIX should have been down. That's usually the relationship. Let's look at gold. We've been looking at gold for a while. As I said before, you can't see, but the high is right in this area at 1980. And then we sold off really hard, and then we've been consolidating. Now this consolidation usually is a trend continuation pattern. And let's see. What's interesting here is it's looking like maybe it's going to retest this upper trend line, but then I think shortly thereafter, maybe into October, something like that, you'll start to see the gold market start to move lower and actually make a new low. This happens a lot when you've had a big move, and this is a big move. I mean, from 1808 down to $1,170. I mean, that's $600-700 move in less than a 3-month period. So that's a huge move in the gold market. And anytime you have a really big move like that, the market has to have time to digest those gains. The buyers and sellers tug back and forth until they can get to some agreement. But having said that, this is usually a trend continuation pattern. The trend is clearly down, and so I would say that we're going to make at least a new low before we go higher from here. So if you're thinking about buying some gold, maybe you should wait until we make a new low down here around 1150 or even 1100. Okay? That's really about it for this week. I really don't have anything to add. I'm watching this very closely, looking at, let's see what the market's doing right now. Let's put in the ES. The ES is the futures. So let's look at, let's just look at an hourly. Looks like they're down 0.75. This is kind of what it's looking like it's happened here. Friday, you can see it sold off pretty hard in the morning, and then spent the better part of the day kind of recapturing those losses. So the high on the futures is 2,375. That could be the high. It could make another high. There's no way to know. So we're just watching it closely. Mostly we're looking at this pattern. We're looking for this pattern to start to exhibit some price action that looks a little bit like this. If we see something that looks a little bit like this and actually breaks through the bottom of this, then we'll probably be looking for a retest. Now, until we take, I'm probably not going to even be talking about a change in trend unless we break this low right here. This low is a pretty important low. So we'll probably put our little box down here somewhere around 1900, 1880. In fact, let's just move this one now. I'll tell you what, we'll move this one since it's clearly out of play. We'll move this one here to about right there. I mean, I just eyeball these. There's no way to really know where the actual spot is. I just like to eyeball them. So what I did is I put this box just slightly below this low. And a lot of times what you'll see is it'll come down and it'll just take out this low and then reverse. And but I would say that if it closes below this low, and if it does, it's likely to close even down here somewhere a little lower. Then we'll look for a retest back up into this 1950 area, and then look for a change in trend. So when that happens, I'm going to be pretty emphatic about it, so you'll know. But we just want to keep an eye on the market. Make sure we hold on to those funds. Don't give money back to the market. Is little. I mean, you can't ever time it perfectly, but you can spot potential trend change, and you can take action and protect yourself. If this sells off, there's no way to know really how far it'll go. I mean, when people start to liquidate positions, and then you have things like margin debt. That's why I was showing you guys the margin debt. Once those margin calls start coming in, people have to sell stock in order to meet the margin call, and that selling begets more selling, and you could have a pretty rapid drop, and next thing you know, you could be down 15-20% in just a few days in your account. So we want to try to keep an eye out for that. We want to make sure we don't have to live through that if we can avoid it, and that's what we're trying to do here in the Middle Class Investor. So send the links to your friends, subscribe to the channel, follow us on Twitter, feel free to leave comments. Some of you have been leaving comments, and I appreciate that, and you've got some input. For the gentleman, I think it was Chief Storm in the UK, if you could send me the symbol for the FTSE, I don't know if I can get it through my Thinkorswim platform, but if I could, we could bring the FTSE up and we could look at that as well. I kind of piddled around and typed in some different symbols, and I couldn't get it to come up, so I might not have access to that data feed. But if you know of a way around that, sure would appreciate it. You can comment on that, and I'll try to pick that up in the presentations each week. Okay? All right, everybody. Well, thanks for joining me this week, the Middle Class Investor, and stay tuned. We'll keep an eye on things for you. Take care, everybody. Have a good week, and have a good Labor Day for those of you that observe Labor Day, which is tomorrow. Take care, everybody. Bye-bye.